Hey folks, welcome to our next video on creating budgets. So, creating a budget. So, the first thing we need to remember is that budgets need to be realistic to have any value. If you just have a budget that's going to be an increase of 100%, so we did $1 million in sales last year, we're going to increase it by 100% and do $2 million in sales next year. Is that achievable? Is that realistic? Maybe. I don't know what your situation is, right? But generally, 100% increase in revenue is not a realistic goal, right? Budgets should be aggressive, so they're hard to hit, but they should also be achievable, right? And they should have a plan behind them. So the goals of a budget are to predict revenue and expenses accurately. This gives us a roadmap that we can follow as managers to hit those desired profit margins, or that bottom line profit loss at the end of the day, right? Like I said, they should be aggressive targets for managers to hit, but they need to be achievable. They need to give us a tool that we can use to hit that profit margin of 5, 10%, or whatever the expectation is of ownership and management, right? If we know we're going to make $2 million and we know we're going to spend $500,000 on food cost and another $500,000 on labor cost, we have a plan, right? We can follow that. We have targets to hit weekly, monthly, quarterly, right? So again, like I said, they need to be aggressive to push everybody a little bit more effective and efficient, right? So they need to be realistic, but they need to push people just a little bit, right? Why should you as an employee or any frontline worker be worried about budgets? Well, budgets are a roadmap for our income, right? For our profit. So if a company is not profitable, then it's not going to be around very much longer, right? A company needs to be profitable in order for you to have a job, right? If your company isn't making money, what's the first thing they're going to cut? They're going to cut labor costs. They're going to cut food costs. They're going to cut repairs and maintenance. They're going to cut, right? To be profitable. They want their company to survive, right? So it's in your best interest to make sure that the restaurant or the hotel or the company you're working for is profitable. Therefore, you're going to have a job, right? If it's really good and profits are really good, then chances are the restaurant could expand to multiple locations, right? Or, they'll create other restaurants in their family. They don't have to be carbon copies, but that could lead to possibilities of having other jobs, right? Or promotion. Say you're a sous chef at restaurant A and they've opened restaurant B, maybe you've got a shot at being the executive chef there, right? Maybe there's a chance of getting more money. If the company is doing well, they're going to reinvest. They're going to fix that oven that's been broken for forever, right? They're going to be able to hire more employees to make your life easier, right? If everybody's hitting the budget, right? And getting that desired profit outcome. So before we write a budget, we need to consider a few things. We need to consider what has happened in the past, right? What has happened in the past historically? What did we do last year for those same time periods? And then what do we think is going to happen going forward over the next month, 6 months, year, right? What are the trends? What, is the price of beef going to be going up? What is the price of produce? So, there's a big drought in the southern states, so produce is going to go up, right? So those are the things that we need to consider when we're writing our budget. And it's twofold. It's the income. So what do we think our our gross income is going to be? And then what do we think our expenses are going to do? What's going to happen to our food cost? What's going to happen to labor cost, right? We're going to investigate upcoming internal and external variables that impact future budgets. What's an internal variable? Well, an internal variable is something we do in-house, right? We decide to shut down the restaurant for a month to completely renovate the front of the house and change all the tables and the decor and all that stuff. Well, we're not going to have any revenue for that month. So that's going to affect our budget, right? External variables are things that are out of our control. So, i.e., the city plans on changing how parking is going to work. Right now we have free parking all around our restaurant. They're going to start charging for parking. So how is that going to affect our business? Maybe the main road coming towards our restaurant, they're going to redo the sidewalks or something like that. So now it's going to be really hard for customers to get to our restaurant. Those are external variables that we can't control, right? Internal, we can control. External, they're out of our hands, right? So then we're going to set our budget goals based on the information we collect and what the owners and management teams desires. What are we looking for our profit margin at the end of the day? What are we looking for capital expenses to replace ovens, right? If we need that oven, then what's our break-even point to increase our revenue to make sure we pay for that oven, right? So we set our budgeted goals. The management team sets goals for revenue growth and expense percents, right? We figure out we're going to have a 24% food cost. We know what our revenue is going to be. We can figure out how much dollars we need to spend on our food for the month, for the week, etc., right? Like I mentioned before, they must be realistic, achievable, and based somewhat on historical data and internal and external variables. If you have a budget of 24% food cost and last year you did 35%, you better have a plan in place to be able to hit that 24%. Then it might be realistic and achievable. But if you just willy-nilly decided we're going to drop food costs by 10% and you don't have a plan on how to do that, then it's not achievable, right? It's not a realistic expectation, right? Our budgets don't have to match our forecasts exactly. We can reevaluate these as we go through the year, right? Oh, hey, we didn't think of this. We can increase our budget. Oh, we didn't think of that. We can decrease our budget, right? But if we're looking far enough out, we can make those changes before it becomes a bad situation and we've already lost money, right? We always want to be looking forward in our forecasting, right? So first example we have here is total sales of income statement were $700,000 and management wants a 5% increase in sales next year. What's next year's total sales budget? Well, this is a simple percentage calculation, right? $700,000 times 0.05 will give us $35,000. That's the amount of the increase. Our total sales budget is that plus that original $700,000, right? Oops, do I have too many zeros? I do have too many zeros. Equals $735,000. We could do this and skip that step by doing the 1.05 to get right to $735,000. Like I've said in previous videos, whichever one makes more sense to you, use that. I prefer to use this one just because I like to know what this number is exactly, right? I know what my budgeted increase is going to be. All right. Next, I have another example. Management says marketing should be 4.9% of sales. If total sales are budgeted at $735,000, what's the marketing budget? Well, it's the same calculation. We have a basic percentage that we're going to take from now our $735,000 budget times 0.049 to give us a marketing dollar of $36,115, I believe. Yeah. So just straight percentage. So we know in our budget that we have $36,015 to spend for the year or whatever period this $735,000 is. Okay, next example I've got is repairs and maintenance. So repairs and maintenance is $17,300. And management wants to cut this line by 8%. So next year's budget and repairs for maintenance. So we want to spend 92% of this 17,300, right? 100% minus the 8% because this is a drop. So we're going to take $17,300 and multiply times 0.92 to give us a repairs and maintenance of $15,916, right? So the key with this one is remember that because it's a drop or a cut, we need to drop this dollar by 8%, which means they're going to do 92% of the $17,300. Okay? All right, next example. So for next year, management knows rent will remain $4,800 per month. Property taxes are increasing to $800 per month, and property insurance will be $630 per month. If these are the only components of occupancy cost, what is the monthly and annual budget for next year's occupancy cost line. So we know our monthly is going to be our $4,800 plus our $630 in insurance plus our, sorry, not plus, equals our 6230. $6,230 is going to be our monthly cost. So for annually, how many months are in a year? 12, right? So we can multiply times 12 and we'll get an annual cost of $74,760. So if we're planning for profit, we're entering all sales and expense dollars based on our forecasts and management goals. So what do we think we're going to do for revenue? And then what do we think our percentages are going to be in order to hit those profit margins, right? We're going to enter them into our spreadsheet, and it does not generate the desired profit. Then we can sort of massage the percentages, right? We can say, okay, well, we didn't get enough profit. We didn't hit our 5% target that we wanted to hit. Then, okay, can we drop food costs by a percentage? Instead of 26%, we can do 25%. But bear in mind, you've got to keep these realistic and plug in a plan with that. It's like, okay, we're going to drop our food costs an additional 1%. How do we plan on doing that, right? Is it by increasing our revenue, or is it decreasing, how many shrimp we put on a plate or whatnot, right? So once we've got a spreadsheet built with all those percentages in there, we can massage those percentages, and let them calculate out what our profit is at the bottom line, right? So we can increase our overall income. Say we're going to do a marketing plan, buy one, get one pizzas. We're going to increase our marketing dollars, but our food cost is going to go up a percentage, right? So is that enough to get us our desired 5% profit, right? So when we plan for profit, right? So changes to the initial budget must be feasible for managers to achieve, or they will never materialize. Every change must come with a plan of action. Like I said, it has to be realistic and achievable. And the only way you can do that is by having a plan. Okay, we're going to do 2-for-1 pizzas. That's going to increase our revenue by 10%, but it's going to increase our food costs by 2%, right? So having a plan on how that's going to work having a plan on how that's going to work compared to each expense, right? If we increase our income because we're doing this, okay, is that going to increase our labor cost? Is it going to increase our food cost? Do we need to buy a new pizza oven? Those things all sort of play together, right? So once we have a budget for, say, a year, how do we divide that into smaller time frames? We can't just simply take a budget and for a year of $1 million and divide it by 12, because January is not going to be as busy as December with Christmas, right? So we need to figure out a way of how we can apply that new budgeted dollars on a monthly basis, right? And it makes it easier if we can break down into monthly budgets or even weekly budgets, so that we can compare a weekly budget to our weekly schedule, our weekly food orders, things like that we can actually manage, right? Using annual budgets, managers cannot catch problems until it's too late, right? So if we break those down into smaller time frames, we can make adjustments on the fly quicker, so that we haven't gone a whole year with our food cost running 35% and we were supposed to have 30%, right? Business fluctuates seasonally, so managers cannot just divide annual budget by 12 or 52 to get the monthly or weekly versions, right? Like I said, you're going to have busier months depending on your type of business. Like if you do a lot of wedding business, June, July, August are going to be really busy for you, right? If you do a lot of, Christmas parties and things like that, November, December are going to be busy for you, right? So depending on the type of business you are, you're going to use your historical data to figure out which months are generally busier than the other months. So you're going to take last year's historical revenue for each month and total annual revenue, and then figure out what percentage of your revenue for the year came from January, came from February, right? So you can see in the formula here, we're going to take the monthly sales from January divided by the annual sales, which will give us the percentage of our total sales for the year that came from January. that came from February, right? We're basically taking our total annual sales and turning it into a giant pie chart, and how big of that pie was January, February, March, etc., right? Once we have that percentage, then we can apply that to next year's annual sales, right? So as an example I've got here, in August last year, sales were $33,300. August sales last year were $33,300. Annual sales were $358,000. If next year's sales budget is $380,000, what should August sales be, right? So the first thing we need to do is figure out what percentage of last year's sales were from August, right? So we have $33,300 out of our annual sales of $358,000. So this is August last year. That's going to give us a percentage of 9.3%, right? So now if we know that our annual sales for next year are $380,000, we can take this 9.3% and apply it to this $380,000. So $380,000 times 0.093 would give us a budget for August of $35,340. So we still have the same percentage of our annual sales for August as we had last year, but we have a bigger number because our overall sales for the entire year went up, right? Okay, so if a manager forecasts $800,000 in annual sales next year, and last year, June was 10.2% of sales. Sorry, I gotta skip ahead here. 2% of sales, and our budget forecast the cost of goods sold at 32.5% of sales, and the annual occupancy is $80,000. And if occupancy costs are divided evenly over the year, calculate the June expense line for cost of goods sold for our occupancy cost, right? So we can look at this, we can figure out our June sales, right? So our June sales are going to be 10.2% of last year. So June sales are going to equal $800,000 times 10.2%, right? We need to change that into a decimal, so 0.102 is going to give us $81,600, right? So that was our percentage for last year. Annual sales next year. Well, we had our 10.2% was last year. So we're going to make $81,600 in June this year, right? So the next part of the question was we wanted to know our cost of goods for June, right? So our budget had our cost of goods sold at 32.5% of sales, and our annual occupancy cost of $80,000. So 32.5% of this $81,000 in June. So $81,600 is what our sales were for June, right? Well, we're going to have a 32.5% food cost, or cost of goods, sorry. We can apply that to our June sales to get a total of $26,520. So we know in June we should be having a revenue of $81,600, and we have $26,520 to spend on our cost of goods, our food cost and our beverage cost, right? Now, the last part of this question was, what's our occupancy cost if they're the same, if occupancy costs are divided evenly over the year? Well, if occupancy costs are $80,000, we just need to divide that by 12 months in the year, right? Which is going to give us a total of $6,667 per month. So easily broken down to our month of June. In our month of June, we have a revenue of $81,600. We have a cost of goods of $26,520, and we have an occupancy cost of $6,667. Okay. And that is how we do a budget. Okay, thanks.